If you're a retiree or near retiree, a new option in the federal government's reverse mortgage program introduced in October of 2010 may make this type of loan more viable for converting the equity in your home to cash for living expenses or other needs. Before I get to this new alternative, however, I want to quickly review a few basic facts about the traditional reverse mortgage, the home equity conversion, or HECM standard as it's known. Essentially, if you're 62 or older, a HECM standard reverse mortgage allows you to borrow against your home and take the proceeds in a lump sum, a line of credit, or fixed monthly payments. The big attraction? You don't have to repay the loan until you die or move, although you do have to maintain your home and pay taxes and homeowners insurance premiums. As attractive as this deal may be, there's also been a rather large drawback to the HECM standard. In addition to interest charges and an annual 1.25% insurance charge on the outstanding balance, the HECM standard also levies an initial insurance premium of 2% of the value of your home. That's $6,000 for a $300,000 home. Although you don't have to pay this charge out of pocket, it does raise the overall cost of borrowing and can make the effective interest rate you pay astronomical if you end up drawing very little against a reverse mortgage or if you die or move from your home shortly after taking out the loan. Which brings us to the new program known as HECM Saver. With a HECM Saver, you still rack up interest and annual insurance charges, but that initial insurance premium is just 0.01% of your home's value, or $30 for a $300,000 home versus $6,000 for the HECM standard. That lower upfront cost makes a reverse mortgage loan potentially more appealing if you're planning to use it sparingly, perhaps as a backup line of credit or an emergency fund, or if you think you may not stay in your home very long. There's one other thing you need to know about the new HECM Saver versus the HECM Standard. Since you'll be incurring a lower initial insurance premium for a HECM Saver, the amount you'll be able to borrow under a HECM Saver is roughly 10% to 18% lower than what you could borrow under the standard program. So if you need a larger loan, a HECM Saver may not be the program for you. Before you take out either type of reverse mortgage, however, mandatory counseling is required to help assure you understand how a reverse mortgage works and to determine whether you can afford to stay in your home after taking out the loan, and for that matter, whether you really need one at all. In some cases, a home equity line of credit or simply downsizing may be a better alternative. You can find qualified counselors by going to the Department of Housing and Urban Development's National HECM Counseling Network site. And even before you see a lender or talk to a counselor, I think it's a good idea to bone up on reverse mortgages, as they can get rather complicated. AARP's website has an excellent section that includes a list of questions you should ask before committing to such a loan, as well as other alternatives you might consider. Finally, although the government backs HECM mortgages, they are made through private lenders. And unfortunately, as a recent Consumers Union report points out, there have been instances of some lenders pushing these loans on people who might be better off without them. I've also written about such abuses, such as putative advisors recommending reverse mortgages and then persuading borrowers to invest the money in high-cost investments such as annuities. So if you think a reverse mortgage may be able to improve your retirement prospects, by all means check it out. But don't sign up unless you're sure it's the right solution for you and you fully understand the costs.